With gold prices reaching a historic milestone of $5,000 per ounce in March 2026, the metal has transitioned from a niche, safe haven to a cornerstone of modern portfolio theory. According to recent Gallup data, investor sentiment toward gold is at a decadal high, with 23% of Americans now identifying it as the premier long-term investment vehicle. For the sophisticated investor, the question is no longer if one should allocate to gold, but how. The following is an analysis of 6 primary entry points, ranging from direct physical ownership to high-leverage speculative instruments. The first way is to own physical gold bullion, such as coins and bars. It is best for investors prioritizing direct ownership and counterparty independence. Directly owning gold remains the most traditional method of wealth preservation. By holding coins, such as American Eagles or bars, investors eliminate the risk associated with financial institutions or brokerage failures. The benefits. Physical gold bullion is a tangible asset with no counterparty risk, and it serves as a definitive hedge against systemic instability. The drawbacks. Physical gold bullion requires secure storage, such as private vaults or safes, and insurance. It comes with higher bid-ask spreads compared to digital assets. The second way is to own gold exchange-traded funds or gold ETF. It is best for cost-efficient, liquid exposure to gold spot prices. ETF like GLD allow investors to gain exposure to gold price movements without the logistical burden of physical storage. These funds typically hold physical gold in secure vaults and issue shares representing a fractional interest in that gold. The benefits. ETF are high liquidity that are traded like stocks, low entry costs, and ETF do not require secure storage and insurance logistics. The drawbacks. Investors do not have a claim to the physical metal itself, and investors are required to pay for management fees, also known as expense ratios. The third way is to own gold mutual funds. It is best for investors who want broad exposure to the precious metals industry. Unlike ETF that track the metal's price, gold mutual funds typically invest in a managed basket of gold-related assets, including physical bullion and shares in mining and refining corporations. The benefits. Investors get a managed diversification in gold mutual funds, and gold mutual funds are accessible through most standard retirement accounts. The drawbacks. Gold mutual funds are often carry higher management fees than passive ETF, and performance may deviate from the spot price of gold. The fourth way is to own gold equities such as mining stocks. It is best for investors seeking operational leverage. Investing in mining companies such as Barrick Gold or Newmont offers a different risk-reward profile. These companies can provide higher returns than the metal itself, because their profits often expand exponentially as the price of gold rises above their cost of production. The benefits. Gold equities are potential for dividends and have significant upside during bull markets. The drawbacks. Gold equities are subject to operational risks, such as geopolitical instability in mining regions, environmental regulations, and management performance. The fifth way is to own gold futures and options. It is best for professional traders and institutional hedgers. These derivative contracts allow investors to speculate on gold's price at a future date. They often involve leverage, meaning a small amount of capital can control a large position. While this amplifies gains, it equally amplifies losses. The benefits. Gold futures and options are efficient use of capital and the ability to profit from both rising and falling markets. The drawbacks. Due to high complexity of gold futures and options, there is a significant risk of total capital loss and not recommended for retail investors without extensive experience. The sixth way is to own self-directed gold IRA. It is best for investors with long-term outlook and tax-efficient retirement planning. A gold IRA allows for the inclusion of physical bullion within a tax-advantaged retirement structure. This allows for portfolio diversification that traditional 401k often lack, while maintaining the tax benefits of a standard IRA. The benefits. The tax-deductible contributions for traditional gold IRA or tax-free withdrawals for Roth Gold IRA and inflation protection for retirement. The drawbacks: Gold IRA has high administrative and custodial fees, and strict IRS compliance requirements regarding metal purity and third-party storage. The bottom line: gold's role in a portfolio has always been unique. As a non-yielding asset, it doesn't generate cash flow, dividends, or interest. Its value lies elsewhere. Gold acts as a long-term insurance policy, a hedge against inflation, currency debasement, geopolitical shocks, and systemic financial stress. Investors don't hold gold because it pays them, they hold it because it protects them. The recent enthusiasm pushing forecasts toward $5,000 per ounce reflects a mix of macro uncertainty, monetary expansion, and shifting global demand. But that headline number shouldn't distract from the real decision investors face: how to own gold. The best method isn't universal. It hinges on two personal variables. 1. Liquidity needs. If you want immediate access to cash or the ability to rebalance quickly, paper gold such as ETF futures or gold-backed notes may be more suitable. Physical gold, while tangible and reassuring, is less liquid and comes with storage and insurance considerations. 2. Risk tolerance. Conservative investors may prefer physical bullion or fully backed ETF. Those seeking leverage or tactical exposure might explore futures, options, or structured products, vehicles that amplify both gains and losses. In other words, the price target is just noise unless it's paired with a strategy that fits your financial temperament. Gold can be a stabilizer, a hedge, or a speculative tool, but its effectiveness depends entirely on how you choose to hold it. Please comment below on your thoughts. I'd love to hear your perspective.